Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Drew, Meredith, welcome back to the Australian Investors Podcast, mate.
Thanks for having me again.
We're talking 10 investment mistakes that people tend to make when they're building portfolios. You've got 10 mistakes. You've got your notes in front of you, which we're going to go over. So just to recap the episodes we've done so far, we did one where we talked about the growth alts and growth strategies, the asset classes in general. Then we talked about defensive alts and defensive asset classes. This one we're talking about mistakes. So sometimes counterpoints are the best lessons. And the next one we're going to talk about, we're going to give a fictitious example of a couple who are trying to build a portfolio that focuses on passive income. And finally, we'll answer questions. So if you do have questions, please send them to podcast@rask.com.au and we'll answer those in an upcoming episode. But mate, today we've got 10 things to get through. So I'm thinking a few minutes on each. If you could give us some examples and we'll just riff from there. I think this will be a bit of fun.
I had to stop at 10. It was quite. I've actually got 14, so we'll have to cut a few off during during the chat.
Well, I'm sure a lot of them kind of loop together and can be solved through some pretty simple strategies. So
yeah. And they all come back to one almost, but we'll save that towards the end.
Yep.
I think otherwise no one will listen to the rest of it.
Yeah, sounds good.
I think the first one we talked about was assuming that something bigger is automatically better. Part of that background in advice in different parts of the industry. And there's always this assumption being with the biggest fund, being with the biggest bank, being with the biggest anything is safer and more trustworthy.
Good point.
Which, I won't put any specific names out there. But big does not equal better or cheaper or more secure. And the other part was that, there's as many billion-dollar businesses that have disappeared in a couple of weeks by poor management decisions as well. So
that's a good point. We see this particularly on the managed fund side, where funds tend to go into asset accumulation mode. They go from let's focus on performance to let's see how much fees we can make in the next year by just bloating the fund.
Yeah.
So does maybe just on that then, when you look at fund managers, is capacity or where they set the limit on how much they can take into the fund a key criteria for you?
I think it is. It's more important for smaller when they're investing into smaller companies themselves, but there is a natural tendency that if you get to a large size and you've got institutional investors who are reviewing you on a quarterly basis against the ASX or another benchmark, that you don't want to lose an institutional mandate.
For sure.
So you can tend to move towards the index. So bigger can in many cases end up in the index. And that's probably why it's something like 80 to 90% of Australian active Aussie equity managers underperform the index.
Yeah. And we do see that, the strategy creep. So you look at funds and you see that they've made a lot of their money. If you look at the attribution, you see it's come from mid caps or something like this in Aussie.
Yeah.
And then as they've got bigger, they can't invest in those companies anymore. So they get bigger and bigger and bigger positions. And their strategy has creeped and all of a sudden they're large cap Aussie, which is pretty, it's a pretty efficient market. So you don't really get that alpha there.
And a lot of the best returns come in the first few years of operations, unfortunately, too.
And that's when most ratings agencies aren't providing any
no one's
ratings
in there but themselves. So.
Yeah, that's it. Okay, so that's assuming bigger is always better, which is not necessarily the case. What's number 2?
Position sizing. The amount of people I've seen, young and old, that will hold, say, there's an example, the meme stocks and the kind of Aussie version of meme stocks where people would buy them as the same holding that they'd have BHP or CBA or CSL in their portfolio. So if you've got investing in a $100 million company, you should size it appropriately. It's higher risk, naturally, hopefully higher returns, but not always the case. So don't position everything the same size.
How about then, so you're saying if you've got would you start from the top down? Would you say we're going to start with strategic asset allocation? You've got 60% stocks, 40% bonds or defensive.
Yep.
And then from there you're going, okay, what's an appropriate level of diversification within each of those buckets? So say, for example, Like if you were looking at a fund manager, say you're looking at an Aussie equities fund manager, and they're doing large cap Aussie, what would be appropriate for you to allocate to, like percentage wise for one manager?
For an individual, well, we'd always say we'd compare it to, we have invested directly in the past, so buying ASX stocks. You're looking at 20 individual stocks in a portfolio. But generally, if you're investing in a manager, they're going to hold 30 to 40, if not more. So you're more comfortable holding larger positions in funds because they're more diversified naturally. So you'd probably hold 2 to 3 times more in an Aussie equity manager than you would in an Aussie equity individually.
For sure. That makes sense. Yeah, we find it doesn't matter if you're advised or you're unadvised. Some people just get position sizing wrong. And it's always an interesting conversation around, particularly when you talk to consultants, how they think about it. It seems like there is some sort of consensus around like mean variance and whatever, but it's kind of each to their own. Number 3 that you've got is focusing too much on cost. Now, this will be, for some listeners, we've taught that cost is everything. Like keep cost low. It's one of the things that you can control. And you've talked in the past about how you have like a fee budget. So where do people go wrong with this?
Well, it's in a few different parts. I mean, if you're looking for professional advice, pay for it. Like things like accounting, like advice, there's people that spend their entire career and you're buying their expertise in that. And I've seen too many mistakes made when people cut corners and think they can do it themselves and then miss something, and it just turns out negatively. That's just on the kind of advice side. And then not being negative towards some of the trading platforms that are growing, more so probably the ones in the US, is the old saying was, if you're not paying, you're the product, is probably the best way to think about it. So if it's free, where's the data going? Because it's not a free service in any other area. So, and then you get what you pay for. So you're buying if you buy an index, you're buying the average. You don't get, the drawdown will be the same as the average. The returns will be the same as the average. I think is key for that one. Yeah,
I think you make a good point there about brokerage as well. Like a lot of those brokers, you have different holding structures as well. Right? Like how your assets held, I think is really important to understand, because you want your money to be safe.
Which is the crypto market's kind of going through that at the moment.
Exactly. Decentralized versus centralized versus half and half, and then getting caught out. Okay, so that makes a lot of sense. Like focusing too much on cost. I think we as an industry now have reached a point where there are so many low cost alternatives. You can save money in certain ways, but in other ways it may not make sense to save money. Like there are certain markets and there are certain types of products, and maybe active is better than passive. And we've kind of reached that point, or getting close to it, I would say. Okay, so number 4 is something that we talked a bit off air about. This is something that we see not just in equities, not just you and I. It's everyone tends to do this. They let this tail wag the dog, so to speak.
So tax-driven investing. If the main premise of investing in something is for tax benefits, it generally means the investment isn't that good. I mean, I'm not saying that negatively gearing isn't a good strategy, but if the only benefit you're getting is from the tax deduction on depreciation or interest payments, the asset may not be that good. It's probably the key. There's examples in the kind of that have caused changes in regulation in the advice industry. So you go back to things like Great Southern and some of these almond and other agricultural plantations, but they're all tax driven. So essentially when you invested, you prepaid fees for up to 5 to 10 years, but got an upfront tax deduction for doing it. So the biggest driver of a lot of those investments was saving tax in 1 year. And ultimately the investments didn't turn out. And most of them went defaulted.
It's like when you go to the accounting conferences and there's the joke, who wants to pay more tax? You should put up your hand because it means you're earning more, right?
That's what my accountant tells me all the time.
And charges you for it.
Exactly.
So we see this a lot, and I think we're going to potentially find out, or at least investors are going to find out, the flip side of this, which is that when you don't have capital growth in a lot of these negatively geared things, whether it's property or whatever, things can go wrong, and that's where things get scary because you don't have that margin of safety. You're basically towing the line between profitability, or holding costs, and it can get pretty hairy.
Tax deduction means you're losing money. Like cash money usually. So that's what you have to be wary of. And if it means you're relying on long-term growth, which has worked in the last 10 years, but plenty of 10-year periods where it hasn't.
Yeah, for sure. How about this one then? So we often get sucked in by gimmicks and like marketing, fund managers, ETF providers, all different types of product providers. It's very easy to succumb to that. And I know a lot of investors that don't have experience in the market will get sucked into the latest fad or theme.
Yeah.
How do you guard against that? Because I feel like that's a risk.
I see that as not having a proper strategy in place.
Mm-hmm.
So the first thing we do with every client we meet is build, it can be up to 30 pages, but 2-page investment strategy.
Mm-hmm.
Says what type of investments we're going to hold, what kind of allocations between asset classes like domestic equities, global equities, and then how many holdings within each, and then where do things like themes or trends fit in there? What sort of allocation should they have? So the key there is when something new comes up, the marketing is great at emotion, connecting with your emotions, like green energy or food or robotics. It's all topical, but how do you fit that in your portfolio? Where does it sit? And what's the premise of putting it in? I think is key. So it's having an actual structure and strategy in place before you consider anything, so you can keep referring to it.
So I feel like there's two risks in here. There's one where you get led into strategies that you don't need.
Yeah.
And the other one is not having a proper strategy. So on that, you mentioned it could be just like a 2-page document.
Yep.
How do you build a real strategy?
How do you build?
Yeah. Like what kind of questions would you be putting into that? Like hypothetical questions? Would it be like, this is my tax strategy, this is my ethical criteria?
Yeah, exactly. The starting point is what do you want? What return do you want? Yeah. What income do you want?
Okay.
And then it all kind of filters from there.
Yeah.
And then you go through what are your preferences? What kind of losses are you comfortable with? Are there certain asset classes you don't want to invest into? What are your ethical preferences? Are you growth oriented? Do you think trends or themes are going to be more powerful sources of return? And then what instruments do you want to use? So we're agnostic to product. So whether it's a fund, an ETF, a stock, an unlisted fund, we'll use anything if it gives us the right exposure.
Mm-hmm.
But it's important to know what your options are or what your preference is when you start. I think there's quite a few groups have kind of basic or templates that you can see.
Yep. I think there's a lot you can download online as well, where you can come up with like just very simple templates of how to construct it yourself.
Yeah, definitely. And then things like rebalancing. So the perfect example would be 30 June. Most people's global or domestic equity portfolios are going to be underweight to where they probably were 6 months ago. And its strategy says if it's, say, 5% underweight, then you should increase your global equity allocation. It may not feel comfortable, but
that is what it is. And I think that's having a plan in place gives you that comfort to do that.
Yeah.
I see this a lot. Like people have come in and they become collectors. I call them collectors. They just buy this, and never really think about what it actually means.
Yeah.
They don't zoom out and be like, well, what am I actually doing here? Do you come across people like that?
I've had clients with 70 to 80 stock investments in a portfolio.
Yeah, wow.
And then it just gets to the point where either you're better off having an ASX 200 index than having 80 investments.
Pay 10 basis points. Yeah.
Or I couldn't imagine the paperwork, having dividend statements come through and the tax return. And then most of the investments have no impact on the return. So what's the point of holding them? Which never comes off well when you tell a client to sell 40 holdings. But I mean, that's our job is to be kind of objective and tell people what they don't want to hear, not what they do want to hear all the time.
Oh, for sure it is. Yeah. I see with different types of asset classes too, there's just like a mismatch of just different things in there that like there's no reference to like how does this react with something else in my portfolio?
Yeah.
The best portfolios are designed specifically to react to certain things.
Yeah.
And if you just throw everything together, you could just have all correlated positions that go south at one time. We're finding that with like tech companies, like people that build portfolios purely out of tech. They're finding that out right now, how hard that is.
Yeah, definitely.
Yeah.
And I think the ease that you can buy things now. So the new ETFs coming out every week. There's a lot of new listed products. You can buy, basically you could be listening to a presentation and buy that while you're in the presentation if you wanted to.
Yeah.
That's not what we would advocate for.
Yeah. Go to the room where there's no one presenting. So it's just a quick one, and maybe just catching a bit off guard here is like, let's say, because you said starting with like what people want. A lot of people that listen to the series want income from the portfolio, consistent income.
Yeah.
If someone had, say, $1 million in their investment portfolio, Could they get, the old 4%, that's sustainable to take out? Is that possible to do right now? Or
Definitely.
yeah?
Yeah.
Because that was built on the premise of you get 7% returns, 3% is inflation, 4% is kind of the return that you get in, after inflation.
I think it's improving. Inflation is going to be the challenging one because inflation is a 12-month kind of rolling. At the moment, it's 5%. It could be 7%, and then it could be 2% next year. But the key would be focusing on that income, but making sure you're buying income that is growing. So not just income that's coming from tax benefits or from companies that aren't reinvesting, but you're actually getting a growing income stream. But I think 4 is achievable. Term deposit rates looking sexy again.
All of a sudden, 3%. Wow.
3.2. You're still like negative 1.8 if you add inflation to it. But 3.2, and only 6 weeks ago, I think you could get less than 1 for a 2-year term deposit. So all those things help in boosting that income. And then, the ASX, I think, is still yielding about 4%. And plenty of new kind of alternative investments as well.
We're recording this in June 2022. Would you consider locking in term deposits at this rate, like knowing that in real terms it's going backwards? Like if you've got a 2-year, say, term deposit at 3%,
the big question,
inflation's 5.1 when the RBA went to look yesterday. Like you're going backwards 2% per year.
Not really.
Yeah, well, yeah.
Depends if you spend money or not.
Yeah, true.
Yeah.
True.
I think for a portion, and depends on the person. If you've got sufficient capital and you can deal with 3% from part of your portfolio, that's a guaranteed 3%. You're never going to lose that money. So for small portions, I probably wouldn't be locking more than a year at the moment. Yeah, who knows? There's just as many people thinking that interest rates will fall or they won't cap out where the market's predicting at 3.8%. And if that's the case, then they'll look attractive. But it's hard. We wouldn't be locking too much in and not for too long. Yeah,
well, savings accounts are also paying decent interest anyway, or cash flow trusts. Okay, so there's another one that you've got here, which is Naïve Diversification. I think this kind of speaks to what we're just talking about. How do you see this playing out?
A lot of people come in with almost the exact same portfolio. They'll have 4 banks, 2 resource companies, a grocery retailer, and they'll think it's the perfect portfolio. I'm fully diversified. I'll be fine. And it's worked. So for 10 years, the ASX has done 10% per annum. Depend which 10-year period. If you went back 2 years, it went 0, went nowhere for 10 years as well. But it's this concept that holding 10 investments means you're diversified. Diversification is diversification of countries, revenue sources, styles, as we were saying, like value, growth, income, diversification of income sources. I think same thing we've spoken about before is, holding 2 ETFs that almost do the same thing. You're still exposed to the same factors and the same risks. So the key is kind of the way you look at diversification, the way you consider it. I've got a lot of clients who refuse to invest overseas. They just think it's high risk to be invested into Apple, Google, Microsoft. And I'd explain, you've got an iPhone, you use Microsoft Word, all these things are used everywhere in the world, but that's still viewed as riskier. But that's the only way you get diversification, is to find exposure to different economies.
Yeah, maybe they are better off in an ETF or something like that, where they can
try.
Feel like they're not investing overseas. Okay, so assuming every asset always goes up is one of the key risks here to building a portfolio. Come on, surely this can't be true.
If your time frame's long enough, they probably do. Capitalism, unless you think capitalism is going to end at some point, which every 10 years it seems like we think
at least one call for it. Yeah,
and I think I've spoken to plenty of people who bought properties and investment properties, all on the assumption that property always goes up, and they've made no money. They've gone sideways. It's been bad tenants. So a rising tide doesn't always lift every boat. And then it's different. So we work with older retirees who are in decumulation. So they're drawing funds rather than putting more money into their portfolios. And in that case, you can't just rely on long-term capital appreciation. You have to start finding other sources of returns, I think is key.
Where do you often look for that?
You go back to diversification, essentially. You don't want to be exposed to a single asset class or as, bond, or relying on interest rates or bond yields, like effectively as where most of the returns have come from for the last 30 years or so.
Yeah, right. Well, you could invest in Japan too, and that's been pretty ordinary for quite a long time, but it could start to look good.
But low unemployment, deflation isn't all bad.
Yeah, true.
Everyone's got a job, and
that's it.
We don't speculate on property. So
and like you said, I think there are certain periods when certain markets perform better and certain products will perform better. I think the value investing, traditional value tilts have underperformed for quite a long time until recently. So everything seems to have their time in the sun. Just assuming that they're always going to work is pretty scary.
And especially when you go down to a company-specific basis too. Like, the ASX might go up, but the ASX drops out companies that go bankrupt or, fail as well. So if you're investing into individual companies, there's no guarantee that the company is going to be worth more. There's a lot of individual factors that go into it.
Got to see the forest and the trees.
Yeah. Always.
How often do you check your investment portfolio?
Personally, once a year, probably.
Oh, really?
For performance, I'll check it when I want to buy something. I'm not a collector. I'm probably a borderline collector sometimes. The way we, internally, we do a quarterly investment committee where we'll go back to what our model portfolio and the way that's invested. Mm-hmm. But personally, it's probably less often than that in terms of performance.
Okay.
More likely when I'm preparing the paperwork for my tax return, my SMSF return.
Yeah. And do you find, because you've named this as one of the risks, do you find clients checking far too often?
Yeah, we can see when our clients log in to our system. Some people log in every day, even though it's not a live system. So the share prices aren't live, and definitely too much. And you can tell. The way we respond to that, we started doing a daily market update because we know people are watching and listening to what's happening to the companies in their portfolio. So how do you answer questions before they come up? And that was our kind of response to it. But I think that might have contributed to more activity as well.
Yeah.
So I think quarterly, in our view, we do quarterly reviews for our clients where we look at everything, tell them about every investment. That's probably too often. Mm-hmm. I think 6 monthly for most people will be fine, unless you're buying something. So put it on cruise control, automate your investing if you're younger, and look at it every 6 months.
But you still have like the rebalancing that might be occurring between that, right? Now. Like I imagine there's a lot of portfolios as we come into June 30th that are looking a bit out of shape. Yeah,
that's why we do it quarterly, because it can, the most global equity strategy down 10 to 15%. So naturally that part of your portfolio goes underweight, and then you make the decision do we want, is our strategic asset allocation to global equities where we want it to be? Yes, then we rebalance.
Yeah. Okay.
But I think, quarterly brings good discipline.
There is so that was looking at your performance too often is one of the mistakes you outlined.
Yeah.
For number 9 here, this is something that it sounds gimmicky, get rich quick. Because I know that you deal with with clients who are typically well-to-do, have quite affluent, or have portfolios in place already.
Yeah.
So they tend to be financially literate. You would look at them and you think they're financially literate, and they're still getting caught out in these things.
Yeah, everyone does. It's just natural. The two things that sell news and sell products is greed and
fear. Yeah,
and it all works perfectly.
Yep.
And
Absolutely.
Marketing and media plays into it all the time. So when the front page of the paper says $38 billion lost, even though the market's worth $1 trillion or $2 trillion, it still gets headlines. So I think it was perfect. The 2020. The part of what we have to do as advisors now is to study behavioral finance as well. So we get tested on behavioral biases.
Oh, right.
And part of this get rich quick is, if you have one good idea, which everyone did in 2020, if you bought any small cap tech stock, you did exceptionally well.
For sure.
Then you assume you can do it again. And you naturally assume, confirmation bias, you assume it's your skill, not luck. Most of the time it's luck. And then most of the time, real wealth gets created through boring old compounding. So the majority of your portfolio, get your 80% core right, let asset allocation and compounding over the long term take care of that, and then play around with your get rich quick on the outside.
Fair enough.
But get your core right, I think, is the key there.
Yeah, have your core in satellite. If that's everyone wants to tinker, right? I feel like if you say don't do this, don't do that, they go and do it anyway. It's like a teenager. They're going to go and try it anyway. So
it's hard to say no all the time.
Quarantine that somewhere else and, separate account or something like that.
With the right position sizing too.
Yeah, for sure.
People, if it's interesting and they know something about it, they're all involved in that sector. If the client's an engineer, and it's hard to be constantly the brick wall.
That's it. They'll find they'll keep shopping around. They'll find a new advisor.
Someone that says yes all the time.
Yeah, that's it. Okay, so this is this final one, which is the 10th risk, which is you've said giving in too soon or changing strategy in the short term. For me, this is one that I think a lot of investors are currently at risk at making. This is the risk that they face, is that all of a sudden their traditional investment approach, whether it's high quality investing or investing in wide moat businesses, is under threat.
Yeah.
And, we've always thought that bonds were a safe haven, but bonds are down, so now everyone's thinking, well, do I need bonds anymore? People are really concerned. Do I sell now and change my strategy? What would you say to them?
Never, as long as your strategy isn't, buying microcap tech stocks.
Yep.
And you're investing, if it's a quality, if it's large cap, or if you're just well diversified and you're just underperforming. I mean, a crisis or a sell-off or a bear market is never the time to switch. Everyone thinks they can sell it, before the bottom. They always feel like it's going to fall further, and they think they can time it on the way up. That's why there's all these papers that talk about how, individual investors always underperform both the index and the funds that they're invested into, because inflows go up after the fund's done well, and the outflows go up when the fund's performing poorly, which is exactly the wrong time.
Yep.
So I think if you've got a long-term strategy and you know what that strategy is, don't let short-term noise kind of drag you away from it. Maybe, if tinker around the edges, if there's companies you think have changed completely, move on and put it into something else, but don't throw your strategy out.
Okay, that's good to know, because like a lot of investors they may have, a strategy that's quite simple, and they think, well, my strategy was to invest in a basket of, I don't know if we use stocks or whatever, and have some ETFs around that, or even some funds. And now they're seeing stocks down 20%. They're seeing some ETFs, even bond ETFs, down 10%. And then they're thinking, well, where can I go? Maybe I'll go to gold because gold looks like it's held up 5% or whatever this year. So maybe I'll put more in gold for the next 5 years.
And that's just part of investing. So, the on average, which we haven't seen for, I think, 10 or 12 years, that a balanced portfolio, so 40-60 between defensive and growth, delivers negative return at least one in every 5 to 6 years. Just part of markets. And the same thing for equity markets. There's more regular negative returns, but that's just part and parcel. The benefit of being exposed is that over the long term, returns have been fairly strong and better than most other asset classes. So
if we didn't have periods like this, then everyone would be constantly invested 100% equities or whatever, right?
Exactly.
And there'd be no alpha to get, no excess return. So just to recap on some of these 10 here, we've got assuming bigger is better. We've got position sizing, focusing too much on cost, tax-driven investments, naive diversification. That's when you buy one or more things that are the same as something else in your portfolio. And that flows into the next one, which is not having a real strategy, which you said can be simple. Just have something, write it down. Assuming every asset class always goes up, or every asset. Property is the prime example in Australia. Crypto is probably another one for speculators. Looking at performance too often. I've got to admit, for my personal performance, I probably look at it like you once a year if I'm lucky, just to work out my capital gains tax and losses.
Yeah.
That's basically it. Get rich quick. That's obvious. We all get sucked into this. It's very, very easy and elusive. Like we see in the AFR or Wall Street Journal, hotshot fund manager comes out and, says this is the new thing, and then we all jump on board. And conversely, the opposite happens too. Yep. And then finally, giving in too soon, which is something that a lot of investors who maybe have those diversified portfolios are thinking, this investing thing is scary. I don't want to do it. I'm going to change strategy. I'm going to go to cash. I heard a horror story. That's all 10, by the way. But I heard a horror story during COVID where a 26-year-old called their super fund and changed to they did a DIY mix. They did 50% cash and 50% like the most conservative option with their industry super fund.
Yeah.
And obviously the person on the other end of the line who I knew, he had to do it because you can't give personal advice.
Yeah.
So he was like, okay, yep. Sure.
And that just capitalizes the loss.
Yeah.
And then you miss out on the,
It was a
100%
huge-
rebound
rip
in
straight out of
S&P
that.
in the 12 months after. So I think if you're young and you're building wealth over the long term, then don't change it. Just make sure you're not naively diversified at the same time.
Yep. And position sizing. That's a question I got recently was, how much crypto should I have? And I was like, well, depends. But anyway, mate, this has been a good conversation. Really easy for people to kind of wrap their head around these 10 things. We'll put them in the show notes too if you just need to reflect on them. They'll be linked to Wattle Partners, so people will be able to find you there. It's Drew at Wattle Partners. You normally put your email address on the podcast, which is pretty brave. So you can send Drew an email, but send us an email if you have a question. You can send a question to podcast@rask.com.au. We're going to answer your questions soon. So please do that. That'll be the 5th and final episode of Passive Income. But the next one, we're going to run a scenario of a $1 million portfolio for a couple that's looking for passive income. So Drew, Meredith from Wattle Partners, thanks for joining me.
Thanks for having me again.